The actual specificity of the data analysis is either wrong or late. And either way, though, it's still showing the same pattern, which is the unemployment rate is going up. The employment scenario isn't great. Wages compared to inflation is still losing. And inflation, even though it's come down a bit, is still connected to higher prices on everything. And these are all indicative of a really much tighter economy. And we have seen on a general basis, and GDP isn't an awesome figure, it misses a lot of things, but last quarter's GDP was only 1.3%. Adjusted for inflation, that is negative growth. So things aren't looking on a full-on general macro basis that good. The reality is people are still getting pinched. The average cost of a mortgage payment has nearly doubled in the last few years as the Fed has increased rates. And what that means is that people are, before they pay for anything else, paying for that mortgage or paying for rents on someone else's mortgage, and all of that's higher. And all of that is beating inflation. The 2% number is completely arbitrary anyway. It was something that was sort of considered, discussed, and vaguely written down in the 90s. It's largely irrelevant to what people's experience is and to what the Fed can actually control anyway. That was an interesting, push aside the actual growing problem that the regulators, including the Fed, are supposed to be actually addressing, saying, and he said in the past it's contained, which it to an extent is, to regional banks, and therefore it's not going to impact the whole banking system. That is actually not true. It is true that regional banks hold the most commercial real estate loans on their books, but they also have a lot of loan deals that connect back into the larger main banks. And so if commercial real estate gets marked down, if the collateral declines in value, it's going to impact the liquidity that the big banks can provide, which is something that the Fed will have to look at. Right now, and this is a really scary statistic that I was just looking into from some analysis that I was doing, which is that the rate of increase in commercial real estate delinquencies and defaults right now is outpacing what it was before the 2008 financial crisis for the subprime market. So that means even before you mark down, which banks are not doing yet, the actual value of the properties, there are already declines in the payments that are coming into these loans, and they are outpacing the rate that they were before the last crisis. So these are things the Fed shouldn't just be saying, well, it's going to be a problem for a long time. These are things that the Fed should be getting out in front of. And last year, when I had this conversation with Pico from this very location in Boca at the Rick Roll conference, gold was around 1919. It was exactly 1919, and of course now we're around 2,400. Why? Because inflation has been persistent. Because central banks, which we know have been purchasing more gold. China, except for the last couple months, I think it's just on a breather, has had 16 months of straight purchases. India is purchasing more and more gold. Turkey, a lot of the emerging market countries, as they diversify their trade relationships away from U.S. dollar denominated trade. That's going to continue. That's priced it up. But retail has really been getting into gold more as well. And there's a couple of reasons for that. It started actually last March when some of the regional banks in the United States went under. The Fed didn't notice it did. They did. And gold kind of rallied about 10% just in the wake of that last March, last April. Then it kind of stabilized and it's gone up since then because of these fears that we've just been talking about that are also in the banking system. Gold is not just a hedge for that inflation that's going to persistently stick around or not be controllable. It's also a diversifier for the risk of our banking system. We saw gold appreciate substantially in the wake of the financial crisis of 2008, and a lot of that was because of buying outside of our system. But now, which we did not have then, we have more and more retail buying. The inflows into gold ETFs have increased, and particularly not just in the United States. In China, where, again, China, big buyer on a central bank basis, the ETFs there for Chinese retail customers have had a major increase and an upward trend of inflows. And so what that means is throughout the world, people are getting involved in buying gold as well. So all of that is coming together to, I think, have gotten the price to gold to the 2,400 range it is today. Last year I said it would get to 3,000 by the end of this year. I still feel very comfortable that in the wake of our election, whatever happens, that adds more uncertainty as well into the overall environment, that we will see gold at those 3,000 levels. I've been a big student of central banks since I worked on Wall Street, since the 90s, since I've traveled around the world. I've met with literally all of them over the years. And there was a power that they really had in the wake of the financial crisis to collectively cut rates, to collectively do QE, to buy bonds, to hold up their liquidity in their own systems and with respect to each other. But now what's been happening in this whole we need to fight inflation scenario is that what we have seen is inflation has come down in pace, but coincidentally, just because of time and the economics of supply and demand, not because the Fed raised rates. And why do we know that? Because as the Fed has paused in the last number of months at that 5.5% level, nothing's really changed in inflation. The only thing that's changed is prices have continued to go up just again a bit quickly than they have in the past. The Fed can't control that. So what can the Fed do? Literally almost nothing. It can't control inflation. It can't control the job market. It says it could. It's its dual mandate, but it really can't. And globally what's happening is more and more central banks which colluded to save each other and themselves in the wake of the financial crisis of 2008 are out for themselves. As there's more dollar diversification, as their own economies and supply chains of natural resources and commodities are more and more important, and they want more and more control over that around the world, different alliances are being built to really focus on that, and they supersede what any individual central bank is able to do, including the United States. Things happen outside of the Fed's purview, and increasingly will. It's not going nowhere, and there's a lot of different ways to actually be involved in gold. There's buying gold coins, there's buying portions of gold bars on various different platforms, so you don't have to actually worry that it's a $2,400 price. And we've also seen that filter into silver, which is a far cheaper price point, and also silver has other use values in energy transformation and other things, and we've seen retail finding its way into that area as well. I don't see any of that changing. I don't see instability going away. I don't see inflation going away. I do see growth going down in general, and we've talked about that. I don't see central banks not diversifying anymore, not wanting to stockpile non-dollar denominated assets in their reserves. There's no reason that any of that should be stopping. It is cheaper, and it does tend to follow gold, although what's happened is that relationship sort of broke down a little bit, that sort of gold started to rally more quickly than silver, but then silver really caught up because the historical relationship is such that it needs to catch up. So right now, even though gold is at all-time highs, silver is only at 60% of its highs in the past, and those highs were basically in a time where we didn't need as much silver for all the energy transformation. So that use value has increased. Silver still has a long way to go to get to even its historical comparative to gold, and I think it will supersede gold because for retail, it's easier to physically wrap your mind around and mentally wrap your mind around a $30, $31, $32 per ounce price tag than $2,400. Even though you can buy gold in slices through these different platforms, you can buy an ounce of silver. You can log into the U.S. Mint site or the Perth Mint site or whatever it might be, and you can actually purchase a certified silver 1 ounce coin, and you can have it, you can keep it, you can give it to your children. So there's all of this, I think, is connected to why silver is going to continue to rally. Yep. I travel a lot. You know that. I'm very sort of boots, heels on the ground. I go to the mine sites, I examine the technology. I'm constantly all over the place, and what Prinsights Global is a way for me to take everything I do and have done, the books, the thoughts, the evolving boots on the ground trends, the sites, and put them into one place. So the Substack that I just launched is a way to provide all of that information from me direct to subscribers of what I'm seeing, what we're analyzing. We've just started our first couple of issues. One is on rare earths and the tariff wars on rare earths that will transcend either administration, whether it's Trump or Biden or whoever that's in the White House coming forward. The recent piece I just did was on gold, on this very conversation and what we can expect to see and why all over the world, as well as the analysis of that. So it's connecting that deep analysis with that boots on the ground perspective and conversations with CEOs and investors and minds around.